welcome to my channel. I'm Stella. Today's video is going to be a little longer because we are going to deep dive into the topic of US dollar dominance and what could happen if the US dollar loses its reserve currency status. Let's dive in. So, what is the reserve currency? A reserve currency is a currency held in significant quantities by central banks and major financial institutions around the world, used for international trade, settling debts, and stabilizing domestic currencies. Currently, the dominant reserve currency is the US dollar, followed by the euro, Japanese yen, British pound, and the Chinese yuan. The dollar alone accounts for over 60% of global foreign currency reserves. Trade settlement examples: when Argentina imports machinery from Germany, even though their currencies are the peso and euro, the transaction is often settled in US dollars because of its stability and universal trust. Energy pricing. International crude oil is almost always priced in dollars. For instance, when China imports oil from the Middle East, payments made in USD, even though neither country uses it as their local currency. Central bank reserves. Nations like China, Japan, and those in the EU hold massive amounts of US dollar assets, like US Treasury bonds, to stabilize their own currencies and boost international payment capacity. Financial market confidence. During economic uncertainty, e.g., financial crisis or geopolitical conflicts, global investors often flee to dollar-denominated assets like treasuries or US bank deposits, viewing the dollar as a safe haven currency. Why the dollar became the reserve currency? Economic size. The US has long been the world's largest economy. Sophisticated financial markets, home to the world's most liquid and stable capital markets, e.g., NYSE, NASDAQ. Trust in US assets. US treasuries are considered among the safest investments globally. Network effect. The more people use a dollar, the more others are compelled to follow, reinforcing its dominance as a global default. A tariff war is essentially an economic confrontation. When countries impose tariffs on each other, it raises trade costs, disrupts global supply chains, and undermines trust in international commerce. The once highly interconnected global economy is being decoupled and restructured, with nations increasingly seeking to reduce reliance on a single country and on the dollar. One of the most significant shifts is that countries are beginning to bypass the US dollar in trade settlements. On the surface, it might look like technical changes in trade, but it hints at a deeper transformation in the global monetary system. China-Russia de-dollarization. Due to escalating Western sanctions on Russia, the two countries have shifted almost entirely to local currency trade. According to Russian Foreign Minister Sergei Lavrov in a speech in 2024, Russia-China trade has achieved almost complete de-dollarization, with over 90% of settlements now conducted in their respective national currencies, the ruble and the yuan. Example: Russia exports natural gas and oil to China in yuan, and the Russian banks are now linking to China's CIPS payment system, cross-border interbank payment system, bypassing SWIFT system. 2. The rise of the petro-yuan. Oil is the backbone of the dollar's dominance. But China has started discussing yuan-based oil trades with oil-rich countries like Saudi Arabia and Iran. For example, deals under discussion involves purchasing oil in yuan via Shanghai's futures market, with Saudi Arabia reinvesting those yuan in Chinese bonds. This is not just a shift in trade, but a reconfiguration of the entire financial ecosystem. 3. India pushes for rupee settlements. To stabilize its currency and reduce dollar dependency, India has been promoting rupee-based trade and energy settlements. For example, starting in 2022, India negotiated with Russia to settle crude oil transactions in rupees. At the same time, the Reserve Bank of India introduced a new mechanism allowing cross-border trade to be conducted in rupees, attracting participations from several Asian and African countries. Iran and Venezuela's alternatives. Sanctioned countries like Iran and Venezuela have no access to the dollar system and are actively creating alternatives. For example, Iran engages in barter trade or uses local currencies with China, Russia, and India. Venezuela has experimented with gold and crypto for international transactions. What's the logic behind these moves? There are several key reasons behind these trends. Avoiding U.S. sanctions. Heavy reliance on the U.S. dollar can increase vulnerability to financial restrictions. Countries have begun to seek financial sovereignty. Strengthen local currencies, especially China, which aims to position yuan as a stable force in the global system. Strategic independence. Controlling supply chains and payment systems gives nations more leverage. Though the US dollar still dominates, these shifts represent early signs of a multipolar currency world. What happens if the dollar's dominance declines? The dollar's status as a top reserve currency is central to America's economic and geopolitical power. A decline in that status could trigger a chain reaction, affecting global finance, markets, and everyday investment strategies. Here are the 3 key impacts. 1. Falling dollar demand leads to long-term depreciation pressure. The global demand for the US dollar is strong because central banks hold it as a reserve currency. Businesses use it for settlements, and investors buy dollar-denominated assets. If more countries use their own currencies, demand for dollars will drop. The impact is that the US dollar may face long-term depreciation pressure, with its international purchasing power gradually weakening. For example, if Saudi Arabia prices oil in yuan, countries might reduce dollar reserves in favor of yuan. Central banks might shift from dollars to gold or other currencies. IMF data shows the dollar's share of global reserves fell to 59% in 2023, a 25-year low. 2. U.S. Treasury appeal drops. Higher borrowing costs. Since the US dollar is world's reserve currency, US Treasury bonds are regarded as the safest asset globally. As a result, central banks around the world purchase large amounts of US debt, helping the US government finance itself at extremely low interest rates. If the US dollar status declines, this natural advantage will also weaken. The impact is that foreign buyers may reduce their purchases for U.S. Treasury bonds, forcing the U.S. to offer higher interest rates to attract investment. This would increase government borrowing costs and exacerbate fiscal deficit pressures. If countries like China, Saudi Arabia, and Russia reduce their holdings of U.S. Treasury bonds, the United States may be forced to raise interest rates in order to attract the capital back. This not only affects the government debt, but also mortgages, corporate loans, and more. In 2024, China's U.S. Treasury holdings fell to the lowest since 2009, a red flag. 3. Global asset repricing, especially dollar-denominated ones. Many key assets, oil, gold, commodities, U.S. equities, are priced in dollars. A weaker dollar means global markets must recalibrate. The impact is that the global markets will enter a process of re-evaluation and repricing, leading to increased volatility. If oil is priced in multiple currencies, the petrodollar system could collapse. Investors may pivot to emerging markets like India or China, especially those with appreciating currencies. Gold and Bitcoin may rise as alternative stores of value. In 2023, central banks globally increased gold reserves, partly as a hedge against dollar risks. A world without the dollar as a dominant reserve currency may signal the end of America's financial advantages and the beginning of a multi-currency world order. A new multipolar currency landscape is taking shape, such as a hybrid system of US dollar plus Chinese yuan plus euro. Although this won't happen overnight, the trend has already begun, and the next 10 to 20 years could be a period of dramatic change in the global monetary landscape. Now we get to the important part. If you're an investor, a shakeup in the dollar's dominance is not just a macro story. It has direct implications for your portfolio. We can look at this impact from 3 key aspects. 1. More volatile returns. When the US dollar is no longer the global capital safe haven, the pattern of global capital flows will shift. As capital flows shift from US assets to alternatives, e.g., emerging markets, gold, Bitcoin, traditional US stocks and bonds may become less predictable. For example, historically, when the dollar weakens, emerging markets rally, e.g., India, Vietnam. During the same period, the prices of gold and Bitcoin have risen as investors seek stores of value outside of the US dollar. Gold and Bitcoin surged during the Fed's 2020 money printing. Bitcoin rose from a few thousand to tens of thousands. Investment advice: portfolios need to be more diversified and shouldn't focus solely on US stocks and treasury bonds. Diversify into emerging markets, commodities, or even crypto for risk hedging. 2. Increase forex risk. If you hold US dollar assets, like US stocks, REITs, ETFs, a weaker dollar can erode your returns in your local currency. The impact is that exchange rate fluctuations amplify investment uncertainty. Even if the underlying asset performs well, overall returns may be dragged down by currency losses. For example, you invested $10,000 in Apple stock in 2024, and it rises 10%. But if the USD weakens by 8% against your currency, your actual gain is just 2%. Pro tip: monitor forex trends or use currency hedged ETFs to manage exposure. 3. Greater commodity price volatility. Many key commodities such as oil, natural gas, copper, iron ore, and gold have long been priced in US dollars. The stability of the US dollar as a unit of account has been one of the key reasons why the prices of these commodities have remained relatively predictable. However, once the world begins to shift toward multi-currency settlement, or if the US dollar status declines, the prices of these commodities will face more variables, including exchange rate fluctuations, geopolitical factors, and the restructuring of settlement systems. The impact that the price trends of commodities will become more complex and harder to predict, and investing in these assets will require higher risk management capacities. Investment advice: when investing in commodities or related stocks, it is important to analyze alongside monetary policies, settlement trends, and geopolitical factors, rather than solely focusing on supply and demand logic. In summary, if you are a long-term investor, consider gradually diversifying into multi-currency assets to enhance your portfolio's risk resilience. The dominance of the US dollar won't collapse overnight, but subtle changes are already happening. As investors, we cannot ignore these signals. We must prepare in advance, enhance our understanding of global financial trends, and make smarter asset allocations. Lastly, don't forget to like and follow the channel. Thank you for watching. See you next time.